All right, let's dive straight in. Today, we're unpacking the fundamental data behind Woodside Energy Group, and we are going to decipher a major puzzle hidden right inside their recent financials. We're talking about a massive player in the global energy market, dual listed on the ASX and the New York Stock Exchange. But right now, their numbers are telling a story of transition, and honestly, a bit of a contradiction. So we're going to look at their operations, check out some valuation ratios, and look at the massive amount of cash they're returning to shareholders to figure out exactly where this energy giant is heading.
So I want to hook right into a fascinating paradox from Woodside's second quarter 2026 report. I mean, it completely defies normal business logic. Think about it. Usually, if you sell fewer goods, your revenue goes down. Basic math, right? Well, Woodside pulled off the exact opposite. Their production volume stood at 41.3 million barrels of oil equivalent, which is just the standard metric for combining oil and gas output. And that is actually an 18% drop from the previous year. Yet, somehow, their revenues surged.
Just look at this number, $4.18 billion US. To put that into perspective, that translates to roughly 6.01 billion Australian dollars in operating revenue, and that's just for the second quarter of 2026. We're talking about a massive wave of cash coming through the door in a mere 3-month window, and get this, they pulled this off while actually taking less oil and gas out of the ground. This right here brilliantly illustrates the current dynamic. Despite producing significantly fewer barrels of oil equivalent, a really high average realized price of $85 per barrel allowed their revenue to absolutely skyrocket. This is the beauty and, sometimes the extreme volatility of the commodities market. When you're a price taker like Woodside, a favorable macroeconomic environment can completely compensate for operational slowdowns or tightening production. They sold 18% less volume but made 20% more money. It's basically a perfect storm of pricing power working right in their favor.
Okay, moving on to Section 1, Operational Reality.
Now, stepping away from the spreadsheets for a second, Woodside isn't just about financial engineering, right? They have massive steel-in-the-water projects that really dictate their long-term future. Their huge offshore Scarborough energy project is nearly finished. It actually advanced to 98% completion in the second quarter. What's absolutely crucial for you to take away here as an investor is that this project has remained on budget, which significantly de-risks the whole operation. It keeps them firmly on track for their first liquefied natural gas, or LNG, cargo in the fourth quarter of 2026. This is exactly what the market wants to see, a major capital expenditure phase winding down and finally transitioning into a cash-generating production phase.
Which brings us to Section 2, Fundamental Valuation Ratios.
So we have to ask, how is the market actually pricing these operations today compared to recent history? We know revenues are up right now, but let's see how the underlying financial engine behaves when we stretch the timeline back a few years. As you can see, Woodside's valuation has notably shifted. The price-to-earnings multiple has expanded to 15.38, even as the return on equity has actually compressed. Back in fiscal year 2022, they generated a massive 25.61% return on equity. But fast forward to July 2026, and that dropped to 7.2%. At the exact same time, the PE ratio more than doubled from 7.04 to over 15, and debt ticked up just slightly from 0.18 to 0.34. So essentially, investors are currently paying a higher premium for lower underlying profitability compared to the boom times we saw in 2022.
To put those valuation multiples into proper perspective, just remember that we're looking at a colossal enterprise here, one valued at over 62 billion Australian dollars. When you're dealing with a ship this massive, structural changes in profitability and production, well, they don't happen overnight. But a $62 billion valuation means the market still prices Woodside as a foundational pillar of the Australian and, frankly, the global energy sector, despite that near-term tightening of production.
All right, let's look at Section 3, Dividends and Shareholder Yield.
Let's transition over to what makes this stock a major focus for income-generating portfolios. Because honestly, for a lot of investors, Woodside is a cornerstone holding simply because of the cash it throws off. Woodside currently boasts a solid 4.82% dividend yield, which translates to an annual payout of $1.10 per share, and that's distributed in US dollars. In a market where yield is heavily scrutinized, a near 5% return just for holding the stock provides a very comfortable floor, especially when you consider the sheer scale and the defensive nature of global energy demand.
Looking at their semi-annual distribution schedule, we can see a really consistent rhythm of cash flow being returned directly to shareholders this year.
They kicked off 2026 with an ex-dividend date in March for a 59-cent payout, which hit accounts later that month. And then, following their standard semi-annual rhythm, there's an August 31st ex-date for a 53-cent dividend paid out on September 24th. It's this clockwork-like return of capital that really keeps long-term income-focused shareholders firmly anchored to the stock. Now, in absolute terms, this represents a staggering $2.1 billion return to investors. That keeps them right at the top end of their target payout range. Listen, when a company can distribute billions in fully franked dividends, meaning they actually carry tax credits for Australian investors, it speaks volumes about the sheer amount of free cash flow their legacy assets are generating. And that's even before new projects like Scarborough come fully online.
Let's wrap things up with Section 4, Future Outlook and Risks.
To give you the complete picture here, we really have to synthesize the company's financial health, management's new direction, and obviously the risks on the horizon. Because let's face it, relying solely on $85 oil to mask falling production isn't a permanent strategy. Fortunately, Woodside is showing some very prudent balance sheet management. They have a deep $8.2 billion liquidity pool, which they actually used to actively retire a $600 million loan about 6 months early. Net debt sits at $9.3 billion, with a gearing ratio, which, by the way, just measures debt against equity, of 21%. That is a very manageable leverage profile, and it gives them a vital financial buffer against volatile commodity prices.
And we also need to talk about leadership. Freshly appointed CEO Liz Westcott is making it crystal clear that cost discipline and streamlining decision-making are going to be the central focus of her tenure. After taking over in early 2026, she immediately announced a structured review to reduce complexity and improve accountability right across the organization. This is a classic, but honestly, a very necessary move. She's looking to find operational efficiencies to ensure the company doesn't just ride the wave of high commodity prices, but actually tightens up its internal financial engine for the long haul.
So I'll leave you with this final thought to chew on. As an investor, reviewing all this data, do the massive revenues and those robust payouts offset the reality of shrinking production volumes? As we've seen, Woodside is currently giving a masterclass in utilizing strong commodity prices to maintain excellent liquidity and shower investors with a near 5% yield. And hey, with the Scarborough project sitting at 98% completion, new production is literally just over the horizon. But with the PE ratio expanding and the return on equity shrinking compared to 2022, Liz Westcott's strategic review couldn't have come at a better time. Keep these fundamental tensions in mind the next time you're evaluating the energy sector.